Well, good afternoon. Thank you so much for attending this session about the entire afternoon about the future of finances and financial advice, and then this session about automated investment services and robo-advisory services. So a little bit of introduction. My name is Bill Winterberg, and I'm a consultant in technology for financial professionals, and I've been doing this for the better part of 10 years. Prior to getting into financial services, I was a software engineer for Hewlett-Packard Company out in California, as well as a toy company called Leapfrog Toys. So I've taken a lot of my analytical and software engineering knowledge and have applied it into the business of financial advice and investment management, and have been doing that full time for a decade. And so when I was approached to moderate this panel, I felt I'm in a pretty good position knowing what I know about technology solutions that are available for you, investment professionals and financial advisors, and identifying how you can leverage tools and technology to deliver services and value to the clients that you serve, whether they be institutions, trustees, or direct investors and retail customers. And so I've had the privilege of coming to know our panel of 4 participants. They sat themselves in a random order, so I'll give them the opportunity, and we'll go from, I suppose, my left over to the right, to allow each one to provide a brief introduction of who they are and the role that they serve in the business, and that'll give you an idea of their purview and their roles and responsibilities in the financial profession. So first, let me introduce right here is Jen Capouya, the head of digital investment solutions with SunTrust Private Wealth Management. Jen, can we get an introduction, please?
Sure, thank you, and I really appreciate the opportunity to be here. And I know that from the Valentine panel, the folks on the side of the room can't really see us, so hi.
We can pull this. Yes, that's right.
Again, thank you for the opportunity to do this. So as Bill said, I'm with SunTrust. I head up our digital investment solutions group, which is a relatively new group. I have actually been with SunTrust for a very long time, about 23 years, and the majority of that time has been spent in wealth management, private wealth management, mostly in the areas of investment strategy. And my most recent penultimate role prior to the one I have now was heading up our investment strategy group, and I was responsible for our model program. And it was about 5 or 6 years ago that I became very, very interested in what I was doing for our high net worth clients in the model kind of portfolio arena, and was very, very interested in the opportunities that we had in that model program to reach our smaller clients in the mass retail or affluent space, but to do so through technology. And it was back then that I became super interested in algorithmically driven investing and the technology interfaces that would, kind of democratize what we were doing in a much, much bigger way, to be able to reach all of our clients at SunTrust, especially the ones that we couldn't reach with our traditional wealth management services. So we set out to develop a solution for SunTrust, and that's what I've been doing for the last couple years now, with a very large team of individuals at SunTrust, including my partner who's here with me today, Casey Howard. She's in the front. And really, really appreciate the opportunity to have gone through that, as well as share some of those insights with you here today.
Terrific, Jen. Thank you so much. And to Jen's right, your left, is Vinod Raman, VP of Digital Advice Solutions with Fidelity Investments. Vinod, would you like to make an introduction?
Sure. Good afternoon, everyone. Pleasure to be here. Very similar to Bill, I have an engineering background as well. In fact, I used to work in the Atlanta area as a software engineer for a couple of different firms. Ever since I've been with Fidelity for about 8 years now, 4 years within the internal strategy group, and then in the last 4 years I've really been leading our digital advice solutions group. And core to what I've done, and certainly relevant to this conversation as well, is building our institutional robo-advice platform from scratch. It's called Fidelity Amp. It's a white label robo-advice solution that we launched late 2017, early 2018. I'm going to share more insights broadly on the robo-advice space, as well as what we've done with AMP in the next half hour, 45 minutes here, but really glad to be here.
Thank you, Vinod. And to Vinod's right is Craig Cintron. He is the, you're a certified financial professional, is that correct?
Yeah, is there CE for this session or what?
You have to sign in the back, make sure that you don't double sign. Senior Manager of Institutional Consulting with TD Ameritrade Institutional. Thank you for joining us, Craig. Can you give a brief introduction?
Yeah, thanks for having me. Like the rest of the panelists, happy to be here and provide some, hopefully some insight and some guidance. I lead a team of technology consultants at TD Ameritrade. My team is basically responsible for working with new and existing RIAs to help them better understand the TD Ameritrade technology suite of solutions, as well as the number of third-party integrated partners who we currently work with. So at TD Ameritrade, for those of you who are not aware, we have an open architecture approach to technology. Today we partner with north of 160 different technology providers, many of which have taken their relationship and integration with us to a deeper level on our newer platform called Veo One. And our approach to the digital advice space is a little bit different than some of our peers in that we actually partner with around a dozen or so different options. And my team actually helps consult with RIAs to figure out, which one of those solutions, if any, are going to make sense for their particular business.
Great, thank you, Craig. And finally, on the far end of the stage from me is Paul Giannini. He is Director of Solution Engineering at Jemstep Invesco. So Paul, would you like to make an introduction, please?
Yeah, certainly. I'm equally as excited as everyone else in the panel to be here. So my background a little bit has really been in technology. I actually have an engineering degree as well. Started out, in software, and actually in my position prior to coming to Jemstep, I spent 8 years at Salesforce. I'm very familiar with the solutions there. And that's where I really sort of, cut my teeth and really got deep on the financial services industry and wealth management in particular, and the application of technology in that space. And that's really what I've, in making the transition to Jemstep about 13 months ago, that's really where, what I've been able to bring to the organization. My role, if anybody's ever heard of solution engineering, is focused on helping our clients or our prospects understand what our technology is, what it does, and how it applies to the business problems that they have. And certainly, with the institutions that we're working with, it's really my job to kind of help make that connection between what we do and where they're trying to get and how we can help them. And so I'm certainly excited to talk about what we're doing in the digital advice space. And we've got one thing that's great about Jemstep is the company's 10 plus years old. So there's a lot of experience that's been drawn on from our early days as a direct to consumer solution. We've taken a lot of that experience and ported it into a white label B2B2C solution. And so that's really what our focus is today is on that solution and helping our clients drive more assets onto the platform and into their business.
Great, thank you, Paul. So we have about 45 minutes remaining today, so I'm going to try and keep up a fairly quick pace. And unfortunately, I think we've stacked the deck with those that have some engineering backgrounds. And I know many of you probably come with investment backgrounds and finance backgrounds and may not necessarily get the engineering connection. But hopefully we can provide over our topics of discussion some ideas and opportunities you can be aware of to identify some technologies and some strategies where you can use this technology and investigate it and perform some due diligence, or listen from our panelists today, where you can take some actions and maybe farm out some responsibilities to your other professionals in your organization to research these solutions and see if this is something that gives you the opportunity to scale your business or provide some services that you may not be providing today in a scalable fashion and maybe at a lower price point. So I have some topics of discussion that I'll talk about core services on what these pieces of technology actually do and how investors work with them and how investment managers and advisors work with them. Then talk a little bit about value add features on where solutions are differentiated and how you can leverage some of these differentiating features in your business. And then we'll talk a little bit about marketing and customer acquisition. Is there a reason for you to market this type of service that you would consider publicly, or would it be something that it does not involve customer acquisition, where you're just rolling it out and deploying it to existing customers that you serve? And then wrap up with a little bit of discussion about fees in the marketplace, because I think there's a lot of heightened sensitivity and awareness around what is happening in the public marketplace with low-cost automated investment solutions and how the public may perceive the cost versus value of the services that you provide. And then we'll have, hopefully, about 10 minutes for your questions. And so you can take the opportunity to write some of those down, and we'll have about 10 minutes at the end of the session, more or less, to address those questions. So with respect to core services, I think I'm going to pick on Paul and Vinod, and possibly you, Jen, as well, with the functionality of the automated investment solutions that we are talking about. I'll provide the high-level discussion that many of these tools are presented to an emerging investor or a new investor with small accounts, and that investor goes through a risk tolerance questionnaire. Through that risk tolerance questionnaire, the investor is presented with an investment solution or a model or an asset allocation. If the investor is comfortable with that model, then that investor chooses to move forward and enrolls in the program and pays a fee for that. And with that ongoing fee that the investor pays, the investor benefits from some periodic rebalancing, which might be as aggressive as daily rebalancing, but that remains to be seen on what functionality does exist. The potential for automated tax loss harvesting, again, for those investors with taxable accounts. This may be something that adds value to the management of their accounts. Some of the features also offer tax location optimization. So tax deferred accounts, qualified accounts, or after tax accounts. Some of these solutions automate some of that management. So that really provides that high level overview. Paul, let's start with you on Jemstep and a quick synopsis of how closely or how far off I described the solution that Jemstep provides to investment professionals, thinking about how do I automate some of my more straightforward models and roll that out to more investors.
Yeah, so the components, many of the components you describe are part of what's included in our offering. So certainly up front, I'd say that first and foremost, when we engage with clients, it's definitely going to be the functionality and the services that are part of the platform, but it's also in working collaboratively with our clients to ensure that we're delivering a solution that is going to be widely adopted.
And to clarify, your clients are the investment professionals, correct?
Yes, exactly. So the services that are generally part of the processes will give you a starting point. The services that we offer, our consulting services, are designed to really help you optimize and fine tune that. So one of the things we find is we've got an idea as to what a good risk tolerance questionnaire looks like when you put it online, and that's going to look a little bit different than a conversation that's across a table or in an office. So being able to strike a balance between what we've kind of seen work, and again, I talked a little bit about the experience that we've had. We've been at this 10 years now. We've got a lot of data that we can draw on in terms of the user testing that we've done, other deployments that we've done. So we have some data to rely on there. So making sure that we're kind of blending the two together, and then being able to include in that steps in the process that actually are oriented around investor goals. So one of the things that we've also learned over time is we take a goal-based approach to how we engage investors. So instead of saying, here's how much more return you can get in this model versus your current, our approach has been to ask investors why they're there and really understand more at enough of a level of granularity to help them see whether they can get to where they want to go, when they want to get there, and then based on the information they provide to us, their appetite for risk, et cetera, is to present to them sort of what that goal is going to look like, and then really whether they can get there or not, and actually it's providing them some tools that allow them to change that and be able to change the inputs to that plan that are going to help them see whether they can get there. So there's an element of sort of what we call financial planning light that allows them to kind of change some of those inputs as a way to not only build credibility, but it's also to help them to see what the investment proposal is that's going to be a best fit for them. So some of the components that we talk about from a service perspective, and I think Craig mentioned it in his description of their solution, is we definitely espouse open architecture as well. Being able to leverage a variety of services that may already either be incumbent, but we also have some existing relationships where we can build in other technology. So that includes the straight-through processing, electronic signature, as well as account aggregation is often included in that flow as a way to help pull that complete asset picture together to really power that goal and make it meaningful for investors.
I'm thinking in my mind the open architecture approach that TD Ameritrade Institutional has versus the open architecture, same terminology, yet
yes,
perhaps some different solutions there.
Yes.
I'll get to that in a little bit because, Craig, I want to get you the opportunity to talk about the custodial perspective of it. But next, Vinod, I want you to address the two solutions that I'm aware of that Fidelity offers. They offer a retail solution, the Fidelity Go solution that any retail investor can sign up without the assistance or inclusion of an advisor. But then the Fidelity AMP, or AMP, the automated managed platform, if I wrote it down correctly,
That's
I
right.
did.
Yep.
That is something that the advisor and the advisory firm engages in Fidelity and then decides to roll that out and introduce it to clients that they want to attract into that solution. Are there some nuances that you want to describe there that our audience needs to be aware of with
Sure.
respect to this, how this technology works?
If you look at the Fidelity Go solution, that is really our retail robo-advisory solution or digital wealth management solution. And if you kind of break it apart, there are really three components to it. The front-end interaction really happens on fidelity.com. So that's where the investor really interacts with the solution. And then if you look at the RIA, it's really Fidelity providing the advisory services and Fidelity acting as the fiduciary directly with the end investor. And then the third leg of the stool is Fidelity providing clearing, custody, broker-dealer services. So that's how Fidelity Go comes together. All of the experience is really, like I said, contained within fit.com. Fidelity AMP is our institutional solution. It is a fully white label solution where our clients are really the brand of the product. Nowhere through the workflow you will see the Fidelity name, the Fidelity branding. It's a completely white label solution. And the three components there are the front end is all built within the e-money chassis. As some of you may know, we acquired e-money 3-4 years back, and we built this product in close partnership with e-money. So it is a fully white label experience, and the end investor is really interacting through the e-money chassis, which again is fully white label. And there is no Fidelity e-money look or feel or branding anywhere in any part of the interaction. The second leg of the stool is the advisor really acting as the advisor, the RIA, the fiduciary. So you have the ability to determine what the risk profile of your investors are. And later this year, the advisors will also have the ability to pick your own portfolios. You don't have to choose the portfolios we offer to you. You can determine what portfolios you want to offer through the program. And then the third leg of the stool is really Fidelity offering the clearing custody services. And that's how Fidelity AMP comes together. The investor interacts through this end-to-end workflow where they are quickly able to, where we are quickly able to profile them, give them a recommendation, account opening, money movement, all of that happens real time by virtue of really using the Fidelity brokerage engine. And then Gio Capital Management is really the other piece in the puzzle. And Gio Capital Management, they were actually part of Fidelity until 2003. Now they've spun off as a separate organization. They act in the capacity of a sub-advisor to the program. So they will contract directly with you, the advisor. And if you want to use the Gio models, great, we can implement that. That's a fast implementation. On the other hand, if the advisor says, I want to use my own models, then Gio would essentially just do the rebalancing for you. So that's how AMP comes together, where we put the advisor in complete control, and it's really they interacting with their investors, really using our comprehensive technology.
Good, good. Thanks for that description. So we have Jemstep as the B2B2C solution, where the advisor is that business entity that purchases the solution and then works with the end client, and very similar with Fidelity AMP, B2B2C. Now, SunTrust brings a little bit different strategy because you have a network, or an army is my word, of internal financial professionals that you want to equip with digital solutions. So can you describe what SunTrust has established?
Yes, absolutely. And so we actually partnered with a competitor and of Jemstep and Fidelity. And so we actually took a very similar tact in that, SunTrust, because we are obviously, B2C, we've got millions of clients that, every single day or, frequently will log on to suntrust.com or open our app. And, they already have kind of digital access to us that way. And so what we set out to do is, again, to partner with a B2B2C company and allows SunTrust to develop in a very hybrid way. So we leveraged a partner, but SunTrust also felt very strongly that in order to reuse technologies and also fulfill our core competencies or pursue our core competencies, but we were going to develop certain aspects of our solution ourselves. So we, very similarly to some of the nuts and bolts that's already been discussed, our solution also entails a very goal-based approach, with retirement being the lead goal. A risk tolerance exercise. We also employ aggregation so that clients can pull up their existing assets and receive a proposal as to what a portfolio on our solution might look like. And all of that is done with no charge. If they decide to continue on and hire us and open an account, as was mentioned previously, that's all done with straight-through processing and fully online digital experiences. And what's really important to SunTrust Private Wealth Management as a business in our strategic plan are these notions of convenience and confidence. Convenience, because we've fully integrated our solution with our online banking and mobile app platforms, but also confidence in that when we bring the investment solution to our clients, we want that to be a very high quality solution, and it really starts with the onboarding or the transition exercise, where it's a very smart transition. So if clients bring us existing assets, which we hope they do, those assets aren't just immediately sold and rolled into a target model. It's a very careful selection where tax impact is taken into consideration. A target asset allocation is what we want to achieve, and we can do that with some of the existing assets that clients bring in. We won't necessarily sell those. We also employ some asset location intelligence. So if a client is opening, say, an IRA and a taxable account at the same time, we'll be careful about where those assets are located. Again, trying to drive that confidence experience through, there's a lot that you're overcoming in the digital space because a human advisor is not involved. And so bringing that additional sophistication level of confidence is very important. And then, as was previously mentioned, once the account's up and running, algorithms do run daily, as you suggested, Bill. And then optimal rebalancing occurs in an optimal or optimized fashion. So typically it's going to involve market movement, or if clients add cash to their account, and then loss harvesting you mentioned as well. The addition, which we hope clients will do, the addition of cash or assets after accounts are opened is also a very convenient feature that clients have available to them, again, through our app or our online properties. And then communication is really important in this as well. Again, digital, not interacting with an advisor, so touch points are really important. And so we have a very proactive and active email, kind of campaign where touch points are, kind of delivered via email. Milestones, there's an activity feed when clients log into their dashboard. I refer to it as the what have you done for me lately, kind of reminiscent Janet Jackson. It's really important to continue to show clients what you're doing for them, whether I just got your cash and I reinvested it, or we just rebalanced. And then we also have, we do have a team of advisors that are backing the solution as well. And I should have mentioned, just in the spirit of transparency, our solution's not fully in market yet. It's in production, it's built, it's in production, but it's in pilot mode right now. So next time, hopefully, I'm able to speak with everybody. We'll be fully launched, and we can provide a lot more details as to how it's working from a commercial perspective.
Very good. But you're getting the interactivity right now during that alpha beta testing phase to figure out what your onboarding customers really gravitate towards and what they find very valuable out of that solution.
Exactly.
Now, bringing a different perspective is Craig. Craig, where you sit inside TD Ameritrade Institutional, you talked about the Veil One platform and the open architecture. So you work with solution providers like Jemstep, as well as competitors to Jemstep that are independent or third-party solution providers of this technology that performs automated investment management. So from where you sit inside TD Ameritrade and its custody functions, are there any particular features, or are there any particular functions that you feel are really gaining traction among financial professionals? Tell me about adoption that you see by the advisors who custody with TD Ameritrade Institutional? What does the rollout look like? What are you able to witness as professionals think about adding these types of solutions, whether they be Jemstep or other options?
Yeah, it's a great question, and this is not a cop-out answer, but it really depends. You know, we work with north of 7,000 RIAs, and every RIA wants to run their business in a different way, and that really led us to have this open architecture approach so that RIAs can have the choice and flexibility to run the business that they want to. So, you know, some things that I've seen as a consultant and now leading the consulting team is it really, you know, do advisors want to outsource all of, you know, this whole solution? Do they want to outsource the trading, the rebalancing, and do you want to use your own models or someone else's models? And that's usually one of the first questions that we might ask in a consulting engagement. Now, if they say they want to outsource the whole thing, there's probably a handful of providers that are really good at doing that and would be a good fit for us to connect them with and get some demonstrations scheduled. Now, if an advisor says, look, I really just want a really slick account opening, you know, now there's a different provider that's in play, and maybe they're going to use, you know, if they custody with us 100%, they'll probably use iReval for trading and rebalancing, which is a solution we provide at no charge. It's really robust rebalancing. If they're multi-custodial, which a lot of advisors are, you know, maybe there's a different rebalancer that they use that, you know, would it make sense if it integrates with that other Robo solution? So there's a lot of different things that we've seen, and I'd say over the past couple of years, the conversations have shifted. I'd say 2 years ago was more around, hey, Robos are going to put us all out of business. We need to have one. Like, let's get to market pretty quickly. And we were doing a lot of engagements. And then a lot of firms got 60, 70% down the way, and they said, we're going to pull back a little bit, you know, and we're going to start to reevaluate what our client experience is. And that's really the shift that we've seen. And I think digital advice and Robos in general have brought a lot of this technology to the front, where RAs are now thinking about, how can I make the account opening better? How can I make the client portal experience better? What do I want that portal experience to look like? We have lots of clients who use e-money, and the conversation is, well, do you want to use e-money as the portal, or do you want to use the custodial site as the portal? And what do you want that experience to look like? To us, it really doesn't make too much of a difference. We just want to make sure you're using the right solutions to help power the business the way that you want to. But to answer your question specifically, like what features are important, I think having the ability to trade the advisor's models or trade other models that might exist in the marketplace, being able to automatically do some of that, a streamlined account opening process, the ability to do billing and maybe even provide some basic performance reporting. Those are all solutions and I say attributes rather that we're starting to hear a little bit more about.
Good, Craig. I hope you've been taking notes about thinking about your business. What are the things that I want to outsource to a technology solution? What are the things that I want to still keep in-house? Do you want to set the asset allocation and then be able to hand that off to technology that can duplicate it and manage it? What about the customer's experience, your investor experience? What site do you want them to use? What mobile app do you want them to use? Do you want them to be checking the accounts at all on a frequent basis? Those are very interesting things from your due diligence perspective that I can see you can take some notes on so that you can approach this with some inquisitive pursuit. So the next phase of questions I want to talk about are some of the value add features. And so we've standardized the discussion around automated investment management, where a model is established, whether you subscribe to a third party's model or you designate your own models, and there's technology that provides the rebalancing, the investment of new capital, the tax loss harvesting, the tax location optimization. But certainly when you think about your business, okay, I add this piece of technology, now where's my value? Have I just outsourced myself entirely and now I don't have any value to my clients? What are some of the other attributes of services that you provide or Craig, that you see in the marketplace that are offering value add beyond the brute force technology that we just talked about with respect to investment management? So Jen, let me start with you. What are some of the value add features that SunTrust is approaching so that you feel your solution and your financial professionals are differentiated in the marketplace?
Right. I would say that, you know, we sought out being differentiated in this space is very important. And it's easy to kind of get caught up in, everybody's kind of race to have a Robo. So from our perspective, we really had to look internally and say, what are our core competencies? What are our clients come to SunTrust for? And so that aspect of convenience, kind of going back to the convenience and the confidence, that aspect of convenience was incredibly important to us. So we sought out to build a solution that was, completely, fully integrated with our existing client-facing digital properties, our online banking, our app, the ability to move money back and forth. That was really important and at the top. Also, our core competency from an investment strategy perspective. We felt that it was very important to leverage the really important intellectual capital and think tank that SunTrust already has and already brings to bear. And so now we make available to an investment of $10,000, certain aspects of that intellectual capital that was previously reserved only for our ultra high net worth and high net worth clients. We provide access to an advisor as well, so I would say that's somewhat differentiated in that we've been, in this business for a very long time. We have a seasoned group of U.S. call center-based advisors that we provide access to, and then I would just say thirdly, the ecosystem. So once you're, kind of in the SunTrust ecosystem, not only do you have access to our additional resources, content, we have a very robust resource center with a lot of additional educational content, but you're also an investment client of ours now. And so, some of the other value-added services that we provide, like financial planning, like insurance, and estate planning services, and once you can kind of graduate up through the ranks, opportunities are, surfaced through that advisor channel that I mentioned, and we can bring those recommendations forth to those clients and get them into the right, appropriate areas of service and products that they need.
As you describe it, Jen, it's a from an investment perspective or investor perspective, quite a compelling value proposition that you paint there from the entire institution, because it makes me think as a individual or running a firm investment professional and thinking about rolling this out maybe at a price point or a tier that I haven't traditionally serviced, I feel that that's a pretty challenge to try and go toe-to-toe with SunTrust. So that's my opinion, not the opinion of anybody else here today. But it's just fascinating for me to think about, and hopefully you internalize, if I'm going to take on this tact in the marketplace, can I go toe-to-toe with a solution like SunTrust that offers some of this value? And that's why I took it upon when we were going through the pre-production of this discussion to make sure we talk about that value add opportunity. Vinod, with respect to Fidelity, you mentioned e-money and e-money's technology. For those of you who don't know, e-money is a financial planning software platform that performs account aggregation, a whole dashboard for a client to see all their investments in one place. They can perform goals-based as well as cash flow-based financial planning, and the advisor can create a full holistic plan with that, and in many cases clients can kind of play in their own sandbox as well, all through a digital experience. So that hopefully paints a picture of what e-money provides. In addition to that value add with Fidelity's relationship with e-money, what other value comes to mind that you feel our audience would be well served in knowing?
Sure. So we've had the benefit of implementing about 40 clients in the last 1 year, banks, broker-dealers, RIAs, some big banks like Fifth Third Bank and PNC Bank, some large broker-dealers like HD West, and certainly some large RIAs like CBIZ Financial and FCG. I guess the biggest learning probably is that one size doesn't fit all. Every client, to your earlier comments, Jen, wants to kind of bring their own look and feel, it might be models, their own nuance into the solution. So a lot of configuration and customization has really been key to how we've really built the offering. But building further on that, what I've seen is that the strategy is a little bit different if you look at the different segments. For banks, certainly what we've seen is integration with the core online banking portal or the mobile app is front and center. So what we've done for example, with a bank like PNC is that you'd log on to PNC and then you'd see this app offering in an advertisement format. You'd click through that. Everything is pre-filled because you've already logged on to the bank. So you're not really, when you're getting to the account opening process, you're not re-entering any information. You're not creating any separate login credentials, it's all completely like the branding is PNC, the disclosures are PNC, so you don't even know you're kind of like getting out of the PNC online banking world, and then you go through the process of quickly opening and funding the account. And since most of it is preferred, it's going to take you 5-6 minutes to open and fund that account. And then once you're back, let's say in like 3 or 4 days, and looking at the account, you're now able to see your bank account, your savings account, and your digital account. That's the integration. And then you're on your app. If you're on the fifth third app, you're able to see your digital account. You're able to add more money to that account. So it's really integrated with the core offering. And certainly, if firms can put in their own models and put in their own branding, it looks and feels very much like their own offering. And banks really look at it as an acquisition strategy. They want to take this to their existing online banking customers and then see if they can move those customers into the wealth management space. If you look at the broker-dealer space, it's a little bit different in that the broker-dealers, at least we've worked with, they look at really digital as a transition strategy. I want to get my lower asset-based customers. I'll first start with segmenting my book of business. I'll say anyone who's under a 500 or maybe even under $1 million, I'm going to put them in this digital offering, serve them through a set of very cool, for the lack of a better word, digital capabilities, and then I want to set it up in a way in that in 3 to 4 years time, if I want to quickly transition them to more of a traditional full service model that, let's say, might be a UMA type of an account, I can do that very, very easily. So we've made that transition very easy because Fidelity ultimately is custodying, whether it's a traditional account or a digital account. We've made that flip very easy and that transition very easy as well. So that is front and center of that strategy. It's really around segmentation and figuring out how they essentially transition their digital customers into traditional. And then certainly if you look at the RIA base, we obviously have penetrated significantly within the existing e-money advisor base. And what they really like about the offering is that as part of the process of really creating this digital account, I now have access to all of the e-money capabilities. Right? So now it's just not a robo-advised managed account solution where I'm looking at that one account, the performance or the goal for that account. I get access to all of the e-money capabilities, which means I get access to the e-money doc vault. I get access to e-money's aggregation tools. I'm now able to go look at where I'm spending. It's almost like a mint.com from that standpoint. So all of those bundle capabilities allows the advisor to quickly get an investor into this digital world and then start cross-selling potentially other services that are more planning orientated. Everything that we've built is certainly goals-based, planning orientated, but kind of like where it really differentiates itself is that once you've set up that account, you now have access to the core e-money engine, both from an advisor standpoint and investor standpoint, that puts the advisor or allows the advisor to do much more using analytics tools and some of the other e-money capabilities.
Right. And so Vinod, as I summarize that, once again, as an individual firm, as an investment manager, I feel intimidated with respect to the power of the institutional solutions, the broker-dealers and some of the other institutions that you serve through AMP. Where it's integrated in the banking app and it's seamless transition into their automated investment service, it can be intimidating for me as an investment management firm to think about how I can, number one, add this to my business, but then number two, compete on a level playing field. And so Paul, that segues to you because you likely with Jemstep serve as B2B2C many more of these individual or independent investment management firms. What kind of value add do you feel that Jemstep brings to that type of relationship to help your clients, your investment management firms, compete on a more level playing field?
I would say that I think the first thing that we really do is I talked a lot about that experience of having deployed this in the past, and really bringing a lot of that experience to when we do the implementation. But I think the other part is when you think about how do you really make this thing successful in the long term is working on and iterating on the solution over time. Meaning, in order for you to, you have to know what's wrong in order to know how to diagnose and fix. And so one of the things that we built into our solution is, well, I guess, first of all, the business is oriented around a concept of customer success. So we have individuals that what they do is their job is to work with work with the firms that we've partnered with and review event stream API data. So we have data that feeds off of our platform about every user that engages with the system from the investor side, looks at where they're spending a lot of time, where you're seeing drop off, where those heavy interactions are happening, etc. And so because we have the ability to tap into that information and visualize it, our customer success folks work directly with those firms to provide some feedback and say, at the investment proposal screen, there must be something wrong here because we're seeing a lot of drop off right there, where people are leaving, people are letting their sessions time out. So part of our mandate is, if you're not successful, we're not successful. So ensuring that we're partnered and we're basically sitting on the same side of the table in that respect is really important. And part of that also comes from, Jen had mentioned the marketing campaigns piece. So making sure that you're leveraging all that information in a way that will make sure you can go back and maybe interact with the folks that might have gotten away. Meaning, if they've come through and maybe they didn't finish, not only is it how can I change what the user experience is, but maybe it's a little bit of one of the firms that we've partnered with as part of our open architecture sort of initiative is with Salesforce on the CRM side. So if you have a client that's come through and you have the ability to actually take that information of somebody who's come through, write that information into a CRM, and then use that as a way to follow up on a lead, or if it's somebody that's already an existing client and they've come in and they're interested in maybe a digital advice, they've done it passively through your site, maybe you've mentioned it to them, and they decide to go in and log in and check it out. All of that then becomes actionable, right? And you can use tools in CRMs that allow you to prioritize that follow-up and do it in a very targeted fashion. And then, of course, you can use a variety of other tools at your disposal as part of that. One of the other things that we do, I talked a little bit about account aggregation as part of that process. We have found that the uptake on account aggregation, prompted from the client side, where they actually are willing and they're ready to enter that information, is significantly higher in this goal-based approach that we have. And that data too also makes it into CRM. And so now you've got all this rich information about all these aggregated assets that could very well be sitting held away. Now you've got this ability not only to say, hey, I noticed you logged in, how was that experience? But you can have in the back of your mind those assets that you can target as part of that conversation. So, bringing the advisor into the experience as well as a way to follow up directly there.
Good, Paul. Craig, do you have anything to add from the institutional custody perspective of value add beyond the rote investment management and the trading and rebalancing that you see your advisors are leveraging in the field?
Yeah, I think, to Vinod's point here, you mentioned if you've got a younger client, or presumably a smaller one, and you want to transition them to a full wealth management offering later, it's easy to do that at Fidelity, and it's easy to do that at other custodians as well, but you have to keep in mind there are providers out there for RIAs today that they don't custody at a Fidelity, a TD, or wherever else. And if you put your clients in that solution, and 4 years later, now they're ready to transition to a full wealth management offering, now you have to have a somewhat awkward conversation, in my opinion, of, hey, we're going to ACAT your assets out and move them to this other custodian. So when you're thinking about your planning process and you're thinking about, who you want to be doing business with, you want to be thinking about those things. But a couple of the other value add things are, how do you make that client experience a little bit better? Do you have the ability, and I think Jen mentioned it, to move money back and forth between accounts? Can you schedule meetings with your advisor? Is there a virtual chat that's available as well through that site? So, do you have an all-in-one experience so that they can go to one site and do almost everything that they need to do? Because when I look around the industry and the competition, I bank with Chase. That's a full offering in a mobile app that they're prompting me to open up a Robo account. There's offers for wealth management. That's a lot of the competition, frankly, and I think a digital experience, if you don't have one, is really going to be table stakes in the very near future.
Good. Thanks for adding that perspective. So in the interest of time, I still have some questions about marketing and customer acquisition. I also have some questions about fees and how much realistic in terms of fees advisors can charge by this. So I want to do a little survey of you, the audience, to find out which topic is more interesting to you, and we'll tackle that one. I'll also say we probably have a microphone once we get this topic tackled. We likely have a microphone available that we can float around the audience, and I'm saying it now because if we don't, they have some time to scramble and make one available. Or I will just repeat the question loudly from the podium. But by a show of hands, who's interested in marketing and customer acquisition for these types of solutions? Raise your hand. I see a couple. How about fees and revenue from these products? There is our answer right here. So I suppose in no particular order, I'm thinking in my mind who would be, we have Jemstep some fees. We have Fidelity AMP with some fees. TD Ameritrade Institutional, your third parties are charging their fees, and then there's custody fees potentially wrapped in with there. And then SunTrust, it's not necessarily a solution that an outside person would purchase from you. So we'll probably end with you, Jen, and then Vinod, let's start with Fidelity and what can investment managers expect from a fee perspective. What does the advisor pay, and then what does the investor pay, or just summarize it and what the fees are in the platform?
Probably this is the first time I'm talking about fees in such a big forum, but Fidelity really charges a very competitive low fee for the offering in the 15-20 basis points fee range. And typically what we've seen is our clients mark that up by a
So
certain
the advisor
number.
adds some additional
Correct.
fee to that
Correct.
for the value add services that the advisor
Exactly, and
provides.
we've seen that kind of like two models are more popular. One is where clients are using this digital offering more in a call center type of a construct, where it's not a specific advisor that is serving that investor. It's almost like a pool of like advisors or maybe some junior advisors serving your entire digital book of business. In that model, the fees are typically lower. I'd say 50 to 60 basis points. All in is what we see, it's one wrap fee. But on the other hand, if it's a traditional advisor-based model where me, the investor, has access to an individual advisor who I can call, email, have that individual relationship with, then we've seen clients charge more. And I'd say that's been in the 100, 110 basis points fee range.
So to reiterate, there is an established fee for the technology for the platform. Then the advisor has a flexibility to
Correct.
assess his or her fee on top of what the charge is for the Fidelity technology.
That's right.
Very good. Paul, let's go for you on fees.
Yeah, so that's the model that we've got is very similar. You know, we charge basis points fees for AUM that's onboarded through the platform, and then the institution generally the firm will mark it up, from there. And many times what they end up charging is because of the open architecture and we're leveraging a number of technologies that are that may already be incumbent. We typically it's going to be one of those things where we've seen them mark it up to anywhere from say 40 to 75 basis points for it. And then I'd say that one of the things we also look at is the segments that we're targeting, right, and whether the relationship exists or not. So I think there's definitely sort of a combination of different factors that are folded in there. There's certainly some obviously implementation costs up front, depending upon how significant customizations are. But generally we've worked as hard as we can to move that into the basis point model, because again we're firm believers in sitting on the same side of the table when it comes to what we charge, because we want to make sure we're going to help them get the most out of it.
Very good. Now, Craig, are you at liberty to paint the picture of what the custody fees are? Because you don't control the fees of the third-party services that an advisor may choose for the automated investment management. Is there some color that you can add to the fee discussion?
Yeah, what I can say is the pricing is all relationship-based, and some firms decide that they want transaction-based pricing, and then other firms want asset-based pricing. So we work with each firm to figure out what's going to be better for them. In the digital advice model, generally speaking, we've seen mostly asset-based pricing, so that the advisors have the ability to do an unlimited amount of trading and not have to worry about exorbitant trading costs over the time. Most of those firms also will leverage our iRebal solution in coordination with something like a Jemstep or some of the other providers out there, and perhaps our model market center, where they've got access to about 200 or so curated models, and those fees or something we haven't talked about is what are the fees for the models, right? If you're using funds or ETFs, some are commission free, some aren't, so that's something you need to keep in mind as well. But I'd say all in, something sub 1% is probably the right number, including the expense ratio for whatever that model is.
Yeah, and Jen, before we get to you, we see in the retail space, the Betterments, Wealthfronts, the Personal Capitals, or the Vanguard Personal Advisory Service, they're across the range from 25 basis points up to about 100 basis points. But the service that they provide is different. Some have no interactivity at all with a human advisor, and some, like a Personal Capital, is very predominant with a human advisor, but that's why their fee is around 89 basis points. And so, Jen, where is SunTrust with respect to its fee and what it is presenting to the marketplace?
Yeah, so building on that point, as good, responsible financial professionals, before we decided to price our product, we did some pretty extensive market research. And what we did was we looked at essentially the landscape of digital advice providers in the US, and we even looked at some non-US, and we looked at the features that were provided as well as the cost of those solutions. And we endeavored to plot ourselves basically on the security market line. If you can think about the two axes that I just described and draw a 45-degree line there, we wanted to be right on that line. We wanted to be, ultra competitive as we bring our solution to the market. So we're at 50 basis points, and that will be, as we plan to launch this product later this year, that's where we'll be. And then to Craig's point, there is an all-in, concept with the mutual funds, or rather ETFs, that we're going to be using in our target portfolios. And so we'll be about 55 to 59, depending on whether you're predominantly equity or, more conservative fixed income. So think about a, kind of 58, 59 basis point all-in cost. With that, you get everything that I described up until now. So all of the, intelligent, algorithmically driven investment management. There are no additional transactions costs. There's no trading charges, and there's no additional cost to access our advisors for guidance and support. And I will tell you, as just sort of a Robo client, I have a couple of accounts, digital advice accounts myself. One thing I noticed last year, because we had a couple dips in the market, the tax savings that my Robo providers generated for me far and away outweighed the actual advisory fees that I paid to them. So I like to say that it's free when the market's down. And when it's up, you're not going to complain because you had a good
Can't put that in marketing.
So there you go.
But your mileage may vary. Consult with a tax professional.
Compliance, yes.
But I do like the efficient frontier of efficient investment
Right.
management fees. I like that perspective of it. So we know that we've talked about there is a spectrum of fees that are charged on the marketplace, and you can now decide for yourself, does my firm fit within that spectrum to be competitive, but also receive a reasonable amount of revenue for the overhead and services and employees that you need to hire to manage this technology? Because for all intents and purposes, we talk about it being automated investment management. There still is absolutely a component that your firm must take on so that when things break, and they inevitably do, somebody is there to troubleshoot, address it, and take control of that and take ownership of it for the firm. Okay. So how are we doing on time? I think we have a couple of minutes before you want to break. Yeah. Okay, so we can take questions. I do see 2 microphones, so if you're so inclined, you can ask your question at the microphone so that we can see it, maybe your name and your firm, and then your question, and we'll try to handle it as efficiently as possible.
I just wondered, when you think about what happened in October and December, that seemed like a time when having an advisor to call was critical. Do you guys see anything about like the heat map of what clients were focused on during that time on your websites? Or like, how do you know whether you were really, like the service model like works when the market goes up 18% in a year? I think it's easy, right? But when you have that volatility, do you find the interaction is greater or less? And how does it compare with a higher touch model? Like, do people say, I'm invested here and I don't need to touch it and it's automated and I don't think about it? Or do they behave? What's the human behavior component of automated versus with an advisor?
Right, and to that point, how do you empower your customers, your asset managers? How do you support them to deal with a heightened sensitivity around market volatility? So anyone want to provide some contribution?
I can provide some perspective there. I think not only during times of market volatility, but even outside of that, what we are beginning to see is that investors are seeking a human voice. In the first year, we launched our retail Robo solution, and certainly what we've seen on the AMP side as well is that a good 40% actually of the calls that we received when we launched our retail Robo solution were actually calls that were seeking positive affirmation that the investor was headed in the right path. It was more around, hey, I've got this recommendation, it's asking me to open an account now. Before I do that, I just wanted to make sure I talk to someone because I'm going to invest $10,000 in it. So it's not just during those times, but across the board, and that's why the traditional robos are now offering human voice, and then the more kind of like human voices are now supplementing technology. And during that market volatility time, what we saw was certainly firms sent out messages saying, hey, you know, the markets are going to come back up. But again, what was important at that point as well was the investor being able to access a human voice if needed. And that we are seeing is the trend now. And we see that at least for the next 5 to 7 years, where that human voice is going to be critical in the relationship.
So activity went up in December or not?
I don't have exact stats on that, but certainly in terms of the people who logged in, it certainly went up in the October-December timeframe to check the balance on their accounts. That activity did spike. Now, whether they reached out to the advisor, I'm not privy to that, but certainly the online activity was pretty high.
Are there any other anecdotes that anyone can share?
Yeah, I would just throw out that the profile of the client, the typical digital advice client, is a bit different. So in the wealth management industry, we're typically used to dealing with clients that have made their money, and they sit there and they've got their $5 million and they see that money fluctuating. And the typical Robo digital advice client has an extremely long time horizon. Many of them are saving for retirement. A lot of them are dollar cost averaging into the markets still. It doesn't mean that this is still not, incredibly disruptive volatility.
Right, they're not impervious to
Right, they're not
volatility,
impervious
right.
to it, but some of the things we try to do is, one, very focused on that long-term aspect. So when clients log into their dashboard, we don't just show them a balance. We show them this huge graph that goes out like 20 years that's got a Monte Carlo around it that's like, here's your money today, $60,000, but 20 years from now, it'll be $350,000. And they, if they're paying attention to that endpoint's not really fluctuating as much. So I would say the only other anecdote I'd throw out there is just the long-term focus, and then of course the access to the advisor that we provide. You can't do this without some access to a human.
And unfortunately, that was some of the marketing and customer acquisition and maybe educational videos or content that's embedded in some of these digital platforms that we had to cut for time. But I'll throw in and interject it. That's an opportunity for the firm to gain some skills and expertise in one-to-many correspondence, one-to-many communication. Can you take advantage of these automated platforms and be able to populate your own custom content, whether it be a short podcast or a short video about current market volatility, but having that importance of that long-term time horizon. And then offering, if you're still concerned, we're here, we have advisors, this is how, contact us via the app. So it's a very effective way to augment that. Since we don't have any more running up to the microphones, we may be all finished. So I don't know that I want to wrap it up because I think we want to break and get on to our next speaker. So let's have a round of applause for our panelists today. Thank you so much for your time and attention. We'll get transitioned to the next session on the agenda.